Okay, hello everyone. So this particular past paper question is related to the September-December 2025 attempt. We will start discussing this past paper as we have a tendency of discussing all the past papers right at the end of the course. So Constant Company is a company that operates internationally and has two subsidiary companies located in foreign countries. Business operations are undertaken in several different currencies. The parent company and the two subsidiaries manage their own financial affairs. Okay. So Constant Company is a company. It operates internationally. It has two subsidiary companies located in foreign countries. Business operations in several different currencies. Parent company and two subsidiaries manage their own affairs. Constant has annual credit sales of 45 million. Credit sales of 45 million. Experience indicates approximately 2% of credit sales become bad debts. Most recent financial statements show trade receivables of 7.5 million. So when receivables are given 7.5 and when credit sales are given, obviously, whenever you have receivables and credit sales, I have told you that we can always calculate the receivable days. Okay. So let's just write here that receivables are 7.5 million and credit sales are 45 million. Okay, this will help you to find receivables. Constant is considering introducing an early settlement discount of 1.25% in exchange for payment within 30 days. It believes approximately 70% customers would take discount while remaining 30% would continue to pay as present. Bad debts would be expected to fall by 225,000 per year. Okay, so companies offering early settlement discount. Okay, and 1.25% is the discount, and 70% customers would take, 30% would continue to pay as present. So at present, you can calculate it. Bad debts will fall by 225,000 per year. Okay. Instead of introducing the early settlement discount, Constant could accept an offer it has received from a factor. Offer is accepted. Factor would take over managing of receivables of the company in exchange for an annual fee of 1.5% of credit sales. Would advance 80% of the value of receivables at an interest rate of 5%. Factor indicated it will reduce average receivable days to 40 days, reduce bad debts to 0.5% of credit sales. Okay. So factor would take over managing 1.5% sales. It would advance 80% and reduce receivable days to 40, bad debts 2.5% of credit sales. Annual credit sales are not expected to be affected by any change in receivable management policy. Credit sales would not change. It has short-term finance cost of 4% per year, and there are 360 days in the year. Okay, so that's the scenario. And using the information provided about Constant Company, evaluate the financial effect of early settlement discount. That what is the impact of early settlement discount, whether you should offer discount or not, because you are offering discount, not receiving discount. It's not creditor management, it's receivable management, whether you should offer discount or not. Okay. Then factors offer, evaluate factors offer, which proposal is financially acceptable. Okay. So let's start discussing this. Okay, so evaluate the financial effect of early settlement discount for marks. Now, if you just evaluate this scenario that Constant is a company that operates internationally, has two subsidiary companies located in foreign countries. Business operations are undertaken in several different currencies. Parent company and two subsidiaries manage their own affairs. Annual credit sales of 45 million and 2% become bad debts, and recent financial statements show receivables of 7.5. So if receivables are 7.5, credit sales 45, you can easily calculate the receivable days here. So receivables 7.5 over credit sales 45 into 360 days. Okay. So receivables 7.5 over credit sales into 360. So existing receivable days are 60. Constant is considering introducing an early settlement discount of 1.25% in exchange for payment within 30 days. Believes approximately 70% would take discount, remaining 30% would continue to pay as present. And bad debts would be expected to fall by 225,000 per year. Financial effect of early settlement discount. You're offering discount. You're not receiving discount. It's not creditor management. You're offering discount. So remember the format of offering discount. You first take cost of discount. Obviously, when you offer discount, there is a cost of discount, reduced recovery. Okay. And then after cost of discount, there are some benefits. Remember the benefits we used to take. decrease in finance cost, then decrease in admin cost, decrease in bad debts. Okay, so we take cost of discount, then all the benefits, okay, and then take net benefit or net cost. Okay, so this is the format of whether to offer discount or not. Okay, it's considering introducing an early settlement discount. Had it said that the creditor has offered a discount, then it would have been whether to accept discount or not. So we take accept, reject, and then take the decision. But here it's whether to offer discount or not. You're considering offering discount. So offering discount is basically whether to offer discount or not. So cost of discount, a loss, decrease in finance cost, decrease in admin cost, and decrease in bad debts. Okay. So let's start the workings. Firstly, cost of discount, I will go for working one. You know that I've taught you multiple times. You can also refer to the working capital management section that cost of discount is basically the recovery issue. Working one. Okay. Existing. So what is the existing recovery? 45 million is the credit sale. You're not offering discounts, so your recovery is 100%. Okay. So existing recovery is basically full 45 million. New recovery. Now, what is the new recovery? Please pay attention. 45 million is the credit sale. Company is offering 1.25% discount. That means people will pay less than 1.25%, 98.75%, but not all people are willing to discount. Had everyone been taking the discount, I would have said that my recovery will fall by 1.25%, become 98.75%. But the thing is that 45 million is the sales. Only 70% are availing discounts. So they will pay me this 98.75%, the 1.25% less. However, the remaining 30% are going to pay me in full, 100%. Getting this point? Now, it's really important that you understand this particular issue carefully. That the new recovery is going to be 45 million less 1.25%. Okay, 98.75%, but not all are accepting discount. Only 70% will be taking the discount. So 70% will pay 1.25% less 98.75%, and the remaining 30% will pay full 100%. Okay. So let's see what is the working here. 45 million, 70% will pay 98.75%. Okay. And the remaining will pay full 100%. So it's 44.60. Okay. So the cost of discount is going to be first you're recovering 45, then you're recovering 44.60. So it's 0.4 million approximately the cost of discount if I make it in a rounding off figure. Okay. So I will write cost of discount as 0.4 million. And the working of this 0.4 million, I think it's in front of all of you. That firstly, we calculate cost of discount as the reduced recovery. So existing recovery, the credit sales were 45 million. So we're recovering full 100%. Now credit sales are still 45 million because it clearly mentioned that the credit sales are not expected to be changed. 70% of billing discount, they will pay 1.25% less, 0.9875, 98.75%, but the remaining 30% of 45 million will pay full 100%. So cost of discount is 0.4 million. Okay. The benefits. Okay. Now, decrease in admin cost. I don't think so. There was any decrease in admin cost, so it's nil. And decrease in bad debts. So decrease in bad debts, it's clear bad debts would be falling by 225,000 per year. So decrease in bad debts is 0.225. Right? 225,000 is 0.225 million. Obviously, you have to work around that. This is 0.4 million. Either you can take it 4,000, and this 225,000, you can take it 0.4 million, so 0.225 million. Okay. And finally, the decrease in uh, a question came from a student that you always taught in the class that decrease in bad debts is also calculated by taking the existing and new. So you can also do it like this. Decrease in bad debts, that you want to take the decrease in bad debts. However, it's clearly written it's decreasing by 225, but still if you want to do it like this. So existing bad debts are 45 million sales, and 2% become bad debts. Okay. New bad debts. They're saying it's decreasing by 225,000. So zero point 0.9 is decreasing by 225,000. So it will become less than 225. 0.675. So again, if you take the difference, decrease is 0.225. So either you do directly or indirectly, it would produce the same answer. So bad debts are decreasing by 225,000, 0.225 million. And the last thing is decrease in finance cost. For that, we will go for working 3. You know how is decrease in finance cost calculated? Again, the existing and new comparison. Again, the existing and new comparison. Okay. So decrease in finance cost will be done like this, that take the existing finance cost. Remember how we used to calculate the existing finance cost. So existing finance cost, remember how do you we used to calculate it? I've taught you in the class. 45 million is the credit sale. So our existing recovery is 45. So we'll take 45 million from the bank. At what rate? 5%, or sorry, 4%. And for how long we need this existing? 60 days. So this makes our existing finance cost as 45 into 0.04 into 60 divided by 360. 0.3 million. New finance cost. Remember how I used to calculate new finance cost? 45 million. Okay. 70% will avail this discount. Okay. They will take funds. For them, we will take funds at 4% for only 30 days. Right? But for remaining 45, 30%, we have to take funds at 4% for all 60 days. Okay. Existing 45 million, 4%. We take fund at 4% for 60 days, but new finance would be 45 million for 70%, 4% rate only for 30 days, but for remaining 30%, 4% for full 60 days. Okay. So this working will be 0.195. So what is the decrease then? 0.105 million. Okay, so decrease in finance cost is 0.105 million. We will add the benefits 0.225, 0.105. Okay, the total benefit is gonna be 0.33 million. Okay, and let's just deduct the benefit and cost. That cost is zero point 0.4 and benefit is 0.33. So net, I think we are in loss 0.07. 0.33 is the benefit, 0.4 is the cost. It hasn't asked for the decision, but discount should not be offered because the financial impact is 0.07 million loss. So you can copy this. We have got the financial impact of early settlement discount, that for offering discount, we take cost of discount. Cost of discount is existing recovery, 45 million full 100%, then new recovery, 45 million 70%, paying 1.25% less, 45 million 30%, paying full 100%. So 0.4 million is the cost of discount. Okay. And decrease in bad debts is 0.225. Decrease in finance cost is existing finance cost, 45 million, 4%, 60 over 360. And new finance cost, 45 into 70%, 4% for 30 days, and 45 into 30% to 4% for 60 days. You do the cost benefit analysis and take the decision that the financial impact of the early settlement discount is a loss. So I've just received a message from the student that the official answer is 0.065 million and your answer is 0.07. It's just due to rounding of impact here. So not to worry about these small things. It's the net cost. Okay, please copy this. Okay, now I will move towards the next issue. That's 5 marks. Evaluate the financial effect of factors offer. Okay, so now it's a factoring part, right? So, in factor, we first write cost of company if factor not appointed. Okay, and then cost of company if factor is appointed. You know the format because formats are the key, that cost of company factor is not appointed and cost of company factor is appointed. I have taught you cost of company factor is not appointed includes interest on bank OD, because obviously if factor is not appointed, we will take from bank. Bad debts, admin cost. Okay. And cost of company factor is appointed. You know that I have taught you one-off fee, factor fee, interest on factor advances, interest on remaining OD, bad debts. I am assuming it's a non-recourse case. Sorry, I am assuming it's a with recourse case because it says that reduce bad debts to 0.5% of credit sales, and it's nothing mentioned that factor will bear bad debts. So we cannot assume it's a non-recourse case because in non-recourse, the burden of bad debts lies on factor. Okay. But since it's saying that bad debts will be 0.5% of credit sales through factor, and there is nothing mentioned that factor will bear, so we have to assume it's a with recourse case. Okay. And then we take decision. Okay. So let's quickly start it. I don't think so it's going to be much problem. So cost of company factor is not appointed, interest on bank overdraft. Okay. 45 million sales. If factor is not appointed, we will take from bank 4% at what rate? 4% for 60 days. Okay. Bad debts. If factor is not appointed, who will bear bad debts? Company. So 45 million. Bad debts are 2% of credit sales. Admin cost, nothing mentioned about admin cost. So total cost if factor is not appointed. Okay. Cost of company factor is appointed. One-off fee. Is there anything about one-off fee? No. Factor fee. What is the factor fee? In exchange for an annual fee of 1.5% of credit sales. So factor fee is 1.5% of credit sales. Okay. Now interest on factor advances. So 45 million. Factor is advancing how much? 80%. At what rate? 5%. For how many days? 40 days. He will reduce to 40 days. Interest on remaining overdraft. So 45 factor is advancing 80%. We will take remaining 20% from the bank. What rate? 4%. for 40 days because now factor is appointed, so we need the money in for 40 days. Point 0.4, 0.04. Okay. And what about the bad debts? Interest on factor advances 45 million, 80% to factor, 20% through bank. That at 5%, this at 4% for 40 days. Okay. Bad debts will now be 0.5% of credit sales. So 0.5% of credit sales. Okay. So cost of the company factor is appointed. We will add all. 1.14 million. Okay. So cost of the company, if factor is not appointed, it's 1.2. And cost of the company, if factor is appointed, is 1.14. Okay. So net benefit or net cost due to factor. So if you don't appoint factor, it's 1.2. If you appoint factor, it's 1.14. So I think because of factor, you are getting saving. Benefit of 0.06 saving. So I think factor should be appointed because the financial impact of the discount was a loss of 0.07 million, but factor is resulting in 0.06 saving. Okay. So we have got the financial impact of early settlement discount loss and financial impact of factors offered 0.06 saving. Okay. Both were easy. Okay. And advise which proposal is financially acceptable. I will write it as well so you can complete this part. So it's just 1 mark, so no need to make it long. Advise which proposal is financially acceptable. So financial impact of early settlement discount is a loss of 0.07 million, but factors offer is a gain of 0.06 million. So factors offer is recommended. So I will write here. You can then copy. Okay, you first copy this. Then we can write the discount offer is resulting in loss of 0.07 million. And factors offer is resulting in gain of 0.06 million. So factors proposal is preferable. That's it. No need to write anything more because just 1 mark. Okay. You can copy this, please. Okay, I will now move towards the next part of this question. Discuss three benefits of a centralized treasury management. In working capital management, I have taught you treasury, that all cash related functions are dealt at one place rather than having one department here, one department here. Everything is at one place. So this is a centralized treasury management, treasury, and the head of treasury department is called treasurer. And then in my notebook, there were advantages of centralized as well as decentralized. In centralized, everything is at one place. Okay. And decentralized, the funds of each branch and division are kept separately. Okay. So benefits of centralization. Okay. I taught you these benefits. So I'm going to write the same three benefits. Okay. Since all cash is at one place rather than each branch holding cash separately, company can negotiate with bank to get good deposit rates. Okay. Every branch has its own cash, so the amount is less. So you cannot negotiate with the bank more. But if all cash is at one place, then obviously if all cash is at one place, it's a huge cash, so you can negotiate with the bank to get good deposit rates. Similarly, in centralization, key staff members are, you can write key and experienced staff members are at one place, leading to fast decision making. Okay. Finally, bulk presence of accounts at one place can help get better borrowing rates. Every branch negotiates separately with the bank. Okay. Small accounts. And you have a huge account at one place. So one party negotiates with the bank. You can also get better borrowing rates from the bank. Okay. So these are the three benefits of centralized. There will be people who will guide you, and there will be some students who will also think very short. How will I get 2 marks? Okay. Let me just show you the official answer. Centralized cash pooling can lead to more beneficial rates in the short term, improving profitability. Okay. This is the official examiner answer. Okay. You see, there is no need to unnecessarily prolong a thing. Okay. Whatever is the benefit, just write it. That's it. Okay. Please copy it quickly. Finally, the last part of this question, 4 marks, discuss two cash management models used in financial management. You know the two models which I've taught you are the Baumol model and Miller model. So you will explain both of them, Baumol model and Miller model. First, I will explain Baumol model. It's just 2 marks. This model is similar to EOQ model, and it tells a company how much should be ordered at a time. No, that's EOQ. How much cash shall be raised at a time. It assumes company has a stock of securities which it can sell to raise cash. Its formula is under root 2 FS over I, where F is the admin cost of raising cash. S is the funds required for a year, and I is the holding cost of. Okay, that's it. Baumol model. Let's discuss two cash management models. One was Baumol model, similar to EOQ. What does EOQ tell? How much should be ordered at a time? What does this tell? How much cash to be raised at a time? It assumes, I have told you, that company has securities which can be sold anytime to raise cash. Formula is 2FS over I root. And what is F? What is S? What is I? Okay. Number two, Miller or model. This model manages cash by setting 3 levels: upper limit, lower limit, and return point. Cash should be kept at return point. So when cash reaches lower limit, it must be brought back to return point by selling securities, and when cash reaches upper limit, it must be brought back to return point by buying securities. Okay, so please copy this. Okay, let's move to the next requirement. Sorry, next question. This is question number 2 of September-December 2025. Okay, let's start reading this question. The scenario relates to 2 requirements. Following financial information relates to mean company, ordinary shares 15 million, reserves 45 million, loan notes 10 million, bank loan 5 million, equity and non-current liability 75 million. So company has ordinary shares, company has loan notes, company has bank loan. Ordinary shares have a nominal value of 0.5 per share, market price of 7.26 per share, dividend of 0.49 per share has just been paid, dividend growth of 5% per year is expected, market price of 7%, loan notes is 4.59 per loan note, interest has just been paid, loan notes are redeemable in 7 years' time at their nominal value of 100 per loan note, variable interest rate is paid on the bank loan, and average rate of interest over the last year has been 8.5%, taxed at 20%, calculate the WACC of mean company. So very, very easy requirement that you know that to find WACC, we first have to make the equation of WACC, okay? And the equation of WACC is basically based on how many sources of finance the company is currently utilizing. So as I can see, companies finance from maximum 4 sources: equity, debt, bank loan, preference shares. Here it's equity, ordinary shares, the loan notes, and the bank loan. So company has 3 sources: equity, debt, bank loan. And you have to find 3 things as well: KE, KD 1 minus T, KB 1 minus T. Okay. So E is the market value of equity. So 15 million is the capital and 0.5 is the par value. So that means 15 million capital, 0.5 par value, 30 million shares. And 7.26 share. So market value of equity would be 37.26. Okay. Debt. So the balance sheet value of debt loan note is 10 million and they are trading at 94.59 by 100. So market value of debt will be 10 into 94.59 by 100. Okay. Bank loan is not tradable, so market value is 5. Okay. Now we are left with KE, KD1 minus T, and KB1 minus T. Okay. So cost of bank loan is given 8.5%. So it's 8.5%. And the bracket 1 minus 0.2. Okay. 0.068. K. For working on K, you either have DVM or CAPM. So I think there is no betas given. So I will move towards the DVM. So it's D1, P naught, G. So G growth rate is 5%. D1 next year's dividend is current dividend, 0.49. Next year's growing by 5%. And P naught current share price, nothing mentioned as ex-dividend, 7.26. So KE is basically D1 over P naught plus G. So D1 is 0.5145 or P naught is 7.26 plus G, it's 5%. So it's 0.1209. Okay. And finally, you have KD1 minus T. So we all know that for this, we first need to find whether it is redeemable, redeemable, convertible. It's redeemable. So IRR 0, 1, 2, 6, 7. We know market value is the outflow, negative 94.59. Then after tax interest, which is an inflow. What is the interest on the loan notes? 7%. So after tax is 1 minus 0.2. It's 5.6%. Redemption. Redemption at nominal. 100. You get net cash flows. 94.59. 5.6. 105.6. Discount factor, that's after tax interest 5.6%. So you can take 6%. 1 to 6 annuity factor. 6%, 6 years annuity factor is 4.917. And the 7th year 6% factor is 0.665. Present value H100, historic 101. You can drag it. NPV. Positive. So for negative, you can make the discount factor 10%. 1. 1 to 6 again annuity. And 10% year 7. 4.868. And 10% for 6 years annuity. 4.355. Present value again. It's H100, H107. Drag it. Next NPV. Discount factor of 10% year 7 is 0.513. Okay, so we've got the negative NPV, and now we will place it in IRR formula to get the KD1 minus T through IRR formula. So it's small a, that is 6%, plus capital A, that is 3.1692, or A minus B, it will be the sum of both of these. $19.19 into B minus A. 10% and 6%, it's 4%. So it's 0.0666. Okay. So I think all stuff is done. I just need to put that in the equation of WACC, and I will get the WACC. So for the equation of WACC, I need to find here the sum of E plus D plus B to make things easy. So sum of E plus D plus B is B97 plus B98 plus B99. Okay. And now let's just put it in the equation of WACC. WACC is KE. What is KE? B100 into E, that is B97 over E plus D plus B, B95, plus KD1 minus T. What is KD1 minus T? It's B101 into D, B98 over E plus D plus B, B95, plus KB1 minus T. It's B102 into B99 over E plus D plus B, B95. Okay. So check this carefully again, that KE B100 into E, that is B97 over EDB, B95, plus KD1 minus T, that is B101 into D, B98 over EDB, B95, plus KB minus T, it's B102 into B99 over EDB. So final WACC is 11.75%. It was a very easy requirement of 10 marks. You can please copy this so that I can move towards the last part. Okay, this 10 marks last requirement, it's very easy. I will just orally explain it and show you the official answer. Critically discuss the relationship between capital structure and WACC. So what is the relationship between capital structure and WACC? Referring where necessary to relevant theory and concepts. Now there are four theories that explain relation between capital structure and WACC. Okay. Relationship between capital structure and WACC, referring to where the necessary the relevant theory. So four theories explain relationship between capital structure and WACC. Number one, traditional theory. Number two, Modigliani and Miller, no tax theory. Number three, Modigliani Miller with tax theory. And number four, pecking order theory. Just write exactly the 4 or 5 lines of traditional theory, which I've explained that as per traditional theory, when debt is introduced into capital structure, WACC falls due to benefit of cheaper debt finance. But when you introduce further debt, WACC starts to rise, and when you introduce further debt, WACC shoots up. That, for example, you introduce debt, WACC reduces 2%. Then you introduce debt, WACC reduces 2%. But equity holders start thinking that debt is increasing, gearing is increasing, risk is increasing. So they start demanding more return, which increases K, and then WACC rises. Okay. Modigliani-Miller no tax theory, when debt is introduced, WACC falls. When debt introduced, WACC falls. Okay. So company should keep 100% debt. Okay. Because when debt is introduced, WACC falls. But I'm sorry, I'm talking about no tax theory. When debt is introduced, WACC falls, but investors are rational. They immediately demand increased K, which offsets the fall in debt. Then you introduce further debt, WACC falls by 2%, investors demand increased K by 2%, which offsets. So any mix would work. But with tax theory states, when debt is introduced, WACC falls, ordinary shareholders demand increased K, which offsets. Yeah, then you again introduce that, WACC falls, ordinary shareholders demand increased K, which offsets. But in the end, the introduction of debt gives tax benefit. So eventually we get more benefit than increase in K. So WACC will fall. So you should do 100% debt, 100% gearing. And pecking order theory is the first finance everything from internally generated funds, then debt, then equity. So whenever question asks relationship between capital structure and WACC, referring to the theories of WACC, so there are four theories. As it is copy paste what I have written with you in the classes, exactly copy paste because it's 2.5 marks per theory. And the material which I have written with you in traditional, no tax, with tax theory, pecking order theory, it's enough to get 2.5 marks each. You can also refer to the official answer C, that the relationship between capital structure and WACC, four theories, traditional, Modigliani and Miller 1, that's no tax, Modigliani and Miller 2, that is with tax, and the pecking order theory. So whenever it asks for relation between capital structure and WACC, that what is the relationship between capital structure, debt, and WACC, referring to the theories, there are four theories. Okay. So we have completed this past paper question. Okay.